Capital and revenue expenditure. What is expenditure? In a layman's terminology, expenditure can be termed as an act of spending money for goods and services. Expenditure is any payment made in relation with goods and services for business. It can also be termed as any expense made in relation with getting benefits for the business. Expenditure can be of two types, namely capital expenditure and revenue expenditure. Let us take a quick look at both of them. Capital expenditure. Capital expenditure is expenditure incurred for acquisition of assets for a firm. A capital expenditure is incurred when a business spends money either to buy fixed assets or to add to the value of an existing fixed asset, life of which may extend beyond the taxable year. Although an expense, the benefits of capital expenditure are enjoyed by a firm beyond a taxable year. This may lead to increase in productivity of an asset, or to increase the earning capacity of a firm, or to decrease working expenditure. Examples of capital expenditure are purchase of plant and machinery, land, and such other fixed assets. Revenue expenditure. Revenue expenditure is expenditure incurred for day-to-day operating expenses in a firm. The benefits of the revenue expenditure usually last only for one financial year. Revenue expenditure is incurred to generally maintain the assets of a firm. A revenue expenditure is an amount that is expensed immediately. Hence, it can be matched with revenues of the current accounting period. Routine repairs, rent paid, salaries and wages given, advertisement expenses, administrative expenses are examples of revenue expenditure. Let us look at the differences between capital and revenue expenditure. 1. Earning capacity of the business. 2. Purpose. 3. Nature. 4. Benefits to the business. 5. Accounting treatment. An example of capital expenditure and its accounting treatment. ABC Company Limited spent 2 lakh rupees on purchase of new furniture. This is in addition to the original furniture purchased of 20 lakh rupees. Identify the kind of expenditure and also show how it will be recorded in the books of accounts. The purchase of new furniture results in the acquisition of additional fixed asset whose benefit will be availed of in several accounting years. Hence, it is treated as capital expenditure. The expense is added to the original cost and is shown on the asset side in the balance sheet of the company. An example of revenue expenditure and its accounting treatment. ABG Company Limited spent 1,000 rupees on repairs and maintenance of a computer. Identify the kind of expenditure incurred and also show the accounting treatment for the same. The expenditure is for repairs and maintenance of an existing asset. It is treated as revenue expenditure because it is the expenditure related to day-to-day activities of a business and is exhausted within one accounting year. It is shown on the debit or expense side of the profit and loss account in the books of the company. Brain ticklers. Capital and revenue receipts. Receipts can be of two types, namely capital receipt and revenue receipt. Let us take a quick look at both of them. Capital receipts. Capital receipts are the funds received into the businesses that are not part of the operating activities of the establishment. Capital receipts include external assistance, market loans, small savings, principal investment in bonds, and government provident funds. It is recorded on the asset side of the balance sheet. Revenue receipts. Any income received in the normal course of business is called revenue receipts. The receipts from the daily sale of goods or services of a company is called revenue receipts. These are usually repetitive in nature. They are recorded on the credit side of the profit and loss account. Some examples are interest on investments, brokerage received, sales, etc. Let us look at the differences between capital and revenue receipts. 1. Meaning. 2. Nature. An example of capital receipt and its accounting treatment. ABX Company Limited borrowed a sum of rupees 2 lakh as bank loan to expand the business. Recognize the kind of receipt and show the accounting treatment for the same. The bank loan taken is treated as a liability. Hence, it is posted on the liability side in the balance sheet. An example of revenue receipt and its accounting treatment. PQR Limited received rupees 20,000 as commission against goods sold. Determine the kind of receipt and show the treatment for the same. Rupees 20,000 is against commission received on goods sold. It is incurred in the normal course of business and hence it is treated as revenue receipt. It is posted on the income side of the profit and loss account in the books of the company. Brain ticklers. A heavy expenditure of a revenue nature incurred for getting benefit which extends to 2 or more years is termed as deferred revenue expenditure. It is written off over 2 years or more, during which the benefit is likely to last. It appears in the asset side of the balance sheet. It can also be explained as those expenditures which have been incurred in an accounting period, but the benefit is spread over a long period of time, but still doesn't create an asset. It is also known as a prepaid expense. Because it has the qualities of both a revenue item as well as a capital item, It is known as deferred revenue expenditure. An example for the same. Heavy expenditure incurred on advertisement for promotion of the company's product is a revenue expenditure. Since the amount spent is too large and the benefits are expected to be received for a number of years, it will be termed as deferred revenue expenditure. For example, advertisement expenditure incurred is 5 lakh rupees. Benefits are expected to be received for 10 years. Hence, every year rupees 50,000 is believed to be spent as advertisement expenditure. Bearing in mind the same example, we can also understand the accounting treatment of deferred revenue expenditure. The total advertisement cost of 5 lakh rupees. Period for which benefit will be available, 10 years. Hence, yearly advertisement expense, 50,000 rupees. This amount of 50,000 rupees will be shown as revenue expenses in profit and loss account. The balance of 4,50,000 rupees will be shown in the balance sheet. Every year, 1/10 part of the original advertising expenses will be written off to profit and loss account. This deferred revenue account will close in the 10th year. That is, it shall have a nil balance after the 10th year. Some examples of deferred revenue expenditure. 1. Rent paid for office premises in advance for more than 1 year. This will be treated as deferred revenue expenditure because the benefits are for more than a year. 2. R&D expenditure for launching a new product of the company would be treated as deferred revenue expenditure because the benefits would last for more than a year. Huge amount paid as insurance premium for the insurance against plant and machinery, where insurance cover is for more than 1 year. To summarize, money spent or money earned by a firm is classified as either of capital nature or revenue nature, depending on its nature.